Okay, folks, welcome back. This is going to be example 15, 16, 17, 18, 19, and 20, completing the review of the ICT Optimal Trade Entry Pattern Recognition Series examples, but with mentorship included, so that we can get a different perspective that's not shown in the YouTube channel. All right, so example number 15, we're going to breeze right on through these. This is the Australian dollar. This is a buy for May 28th, 2020. And as you can see, there's several things already on the chart. And we're going to take a look at this in a little bit more detail now. New York session, time of day. And I want you to look at a few things in here. Look at the consolidation in here ahead of the New York session. Now, there's lots of buy-side liquidity resting above this high, this high, this high, this high. Okay, so you already know where I'm going with this. This old high comes in at 66.35 and 9 pip bets. You can see that here. And 30 pips above that gives us 66.65 and 9 pip bets. Okay, so 30 pip grade, sweep, and reach for liquidity. And the New York session in here, we already start to see a price run. So we're under the assumption that it's going to be a low resistance liquidity run because of the buy side liquidity that's resting in here in the higher time frame. Daily bias intact, it's looking for higher prices. The market breaks this short-term high. It clears it, but notice what it does here. It goes 1, 2, 3, creates a big caffeine bar. Okay, that's what I used to call it in the 90s. A big old candle like that. All right, it's taken off. It's left the old high here, but it creates a fair value gap. It's defined by this candle's low and the previous candle's high. Price comes back down. Look at the buys of the candle respecting it. Okay, that's not randomness. Okay, that's IPTA. Now again, all of the tails on these candles, much like the wicks, that's always going to be attributed to the broker's in-house liquidity. So put it in perspective, another study for you to look at and consider. If you go through TradingView and you pull up the names of the currencies, it'll often give you like Oanda, Forex.com, which is the data feed I use, so that way you guys can look at the same thing I'm seeing. And there's a couple other various different brokers in here. Whenever you're looking at examples like this, look at the close and the open of the candles and then the lows on the tails and then the highs on the wicks. And you'll see what I'm referring to when it's the broker's in-house reach for liquidity. They're never going to agree all the time. I mean, once in a while they might, but for a general rule of thumb, that's why we focus on the bodies of the candles and we just allow the wicks and tails on the candlesticks to just be somewhat noisy. Okay, and I'm refraining from using that term a lot in my delivery of instruction, because very infrequently is anything really noisy. Sometimes when we're in a real tight consolidation or congestion, then it can be. And when it's not like that, everything else is pretty much to script. You know, we can pretty much get a close read within 5 pips, which to me is phenomenal, because you're talking about the world's economies and currencies and indices, and it's just amazing when you take a step back and look at how predictable and reoccurring these things are. And if it wasn't running on an algorithm, it wouldn't be like this, because if 90% of traders lose money, then why is it that these things that I'm teaching you work as high a degree in consistency? Because this is the truth of the marketplace. It's not the fluff and retail stuff that you're forced into and indoctrinated as a trader. And then you come in, you deposit your money, you lose, you walk away assuming that nobody makes money, and there it is. When in fact, there's a lot of people out here making money, but they're not doing the things that you're learning from them books. So I want you to take a look at the fair value gap, how we come back in. Look at the bodies of the candles respecting that, not the tails, just the bodies. We come right down to the bottom of it here, and then we rally back up. Down here, before we left this high and broke above it, we already had a fair value gap inside of the New York session, and we have an institutional order flow entry drill technique, okay? And at the end of this video, I'm going to show you how to go into the forum and find things, because I am slammed with emails that repeat over and over and over again that they don't know how to use the search function in the website. So as a bonus on this video, at the end of it, I'll show you how to do that. But what we see here is this is an institutional order flow entry drill. It's actually an entry technique that I teach you. And we don't require the gap to completely fill in. Like this here is the same thing as this. Okay? This is where you would get filled if you were looking for entry drill as your entry mechanism. Okay, in other words, what's putting you in the trade? It's got to go to this candle's low, which is 66.30 and 7 pipettes. If it trades to that or lower, you can be a buyer. You just add your spread to that, and that would be your fill, not requiring the entire closure of the gap. And when it does these types of things and comes down and then runs, then you know that this is a breakaway gap. You don't need to worry about this as a gap that would fill. Okay, so if this is a breakaway gap, then you have to go back further to the left inside the market structure to see, is there another gap prior to this one? We have it here. Okay, so is there a gap prior to that one within this market structure? And there was one right here, but it was an immediate rebalance there. So we have a gap here that's ahead of breaking out above this high. So this becomes a breakaway gap, and this is a measuring gap. Okay, so the measuring gap is about halfway of whatever the move will be. Breakaway gap just shows you that it's trying to get to a direction in a hurry. What direction is it trying to get to? Above this high where the buy side liquidity is. So if we look at this whole entire price run here, I'm just going to add a fib on it just real quick, just to show you for illustrative purposes. No extra charge. All right. Here's 50 level. Okay. What exists right there? That's the gap. That's your measuring gap. Measuring what? Halfway. Down here, you have what? A breakaway gap. So it's 1/4 of the way, half the way. Here's another gap right in here, 3/4 of the way with the institutional entry drill. Boom. And finally comes the terminus. Oh my goodness. This is like so not random. Yeah, about that. So when you look at price runs and you look at market structure together, it gives you a completely different perspective on price. Nothing seems surprising. Nothing seems out of the blue. Where did this come from? You're not taken by surprise with all of these things. But it takes time. So while I might show you this and you're wowed and floored and your jaws, hanging open, just know that it's going to take you time to see these things, and it's not long that it takes you to do it, but you have to do these things in your journal. And I'm going to show you how to more or less go find in the forum where you can see the lesson I gave on how you can create a journal. Now, it's not the only way of keeping a journal, but these are the types of things like I just had on this leg here to here with the fib, measuring that. Okay, so this is where you grade price swings. So it's not quarters theory. Okay, all that stuff is just, that's nonsense. What I'm showing you is where you can actually forecast before the moves even come, where these fair value gaps will form or likely to form. So it gives you not only a price area, okay, where it should work within 5 pips, because that's the degree of variance that I allow for. And if you mark off in the future where those price levels should be, what are you doing? You're fortune telling. Okay, you're looking into the future, and you're forecasting a price move that has not even traded to that area yet. Think about it. It's amazing. It's absolutely amazing. Now, how did I know that? How do I know these things? Because IPTA is programmed to do these very things. It's not the fib. Okay, the Fibonacci isn't the thing that's making it work. It's the equidistant movements from one low to one high, and how those things are broken down into quadrants. Okay, so when you grade a price swing, not only can you use it in the hindsight perspective and study and look where things have happened before. But when you understand what it's likely to be doing, you can use these price legs and project in the future setups that have not even entered into that area of price action yet. So while price was down here, we could anticipate price running to this level up here, 30 pips above here. So right away, before we get to this business here, which I'll make very clear in a moment, but this high and this low is something that you could have easily forecasted because of the market structure from this high to this low and all the buy sell liquidity. So if it's going to run above that, it can go 10 pips, 20 pips, 30 pips. Well, Michael, how do you know if it's not going to just go 10 pips, 20 pips, 30 pips? That is covered in the core content. Okay? Don't be in such a hurry to know everything because you can't cram. It's just like when you're in school, you can't try to study everything the day before the test. You had months and months and months to study, but you chose to do whatever you wanted to do. And then the night before, you're trying to cram everything in it, and you never, ever can do that. That's why mentorship is a journey. You're here with me every single week, and you learn more, and more information and understanding is deposited because you're exposed to certain things over and over and over again. You can't just watch a video and think you're a smart guy or gal and go out there and try to teach this stuff, okay? Because you don't know what you're doing. Only thing you're going to do is parrot what I'm saying, and you don't even know where I'm taking the lesson. So many things are going to be learned by experience, and this is just simply one of them. All right, so the institutional order flow entry drill right in here. This is the swing low that I elected to use for the optimal trade entry. And the reason why is because this low should not be violated because of the things I've already outlined here regarding the gaps and the run above this high. So in other words, when it ran above here, it should not come back down and take that out because this was already showing you that it wants to go higher. It doesn't need to go any lower. If it does, that's a problem. Okay, so you can run your fib to get your measurement on your dealing range for your optimal trade entry. So low. Why this low, Michael? Because it's got a gap here that didn't completely close in, and we've already ran above this high. So if it comes back down into that, that's not actually a good thing. It'll want to go lower if it does that. So this low up to this high, we trade back down into optimal trade entry, 62, 70.5 sweet spot, and 79% retracement level here. Retraces within the New York session and expands up. And our projected high for this swing is 66 and 67.5. And that's what you get here to the pip using this. Now, can you get any more precise than that? Because it's to the pip at. You don't get any closer than that. Look, folks. Look at the high here. 66, 67, and 5 pipettes. That's what you're getting here with the fib. Now, add that with confluence of 30 pips above the old high, which comes in at 66, 65, and 9 pipettes. Look at the bodies of the candles in here. They're hanging around that level. Yes, it gets to the fib level, but again, that's just one element. Fibs aren't it. You have to look at the whole entire spectrum of what price is doing so that we understand what its delivery is, why is it trying to go somewhere, and why it shouldn't go to another place like I outlined here. It should not come back down into this area once it broke that high. So this is a measuring gap only because back here we have a previous gap that stayed open. So for your notes, this is a breakaway gap because it stays open. This is a measuring gap because it stays partially open and it runs after it goes into the gap. So we have an institutional order flow entry drill, explodes to the upside, another fair value gap in here. Just is just more or less a revisit back to this. This is your midpoint. This is a fair value gap. Notice that I'm classifying this as a fair value gap because now this is returning back to fair value after the displacement above this high. Whereas this is not displacement that needs to be rebalanced because it's not broken out above this high yet. Okay, so hopefully you found that one exciting. Let's go into our next example. For example number 16, this is in crude oil for a buy on May 29th. All right, so we're looking at the crude oil market here, and this is May 29, 2020. And I'm going to just go through this one rather quickly because there's really not too much to it. So we have the London session backdrop Okay, so in other words, it created its optimal trade entry for the day, creating the low of the day. And crude oil has been bullish. We mentioned that we were looking for higher prices anyway. We had that daily gap that was on multiple points of discussion, both public and in mentorship. So we have a fair value gap that trades down into it here, and then it rallies up. And yes, I'm aware that the New York session's over here. I'm just giving you the backdrop behind what makes this a bullish scenario. Previous day's high back here, so you need buy side liquidity resting above here. This low right there, as it drops down into it, that point of entry at the 70.5 level is also a rejection block. See the down close here? Close at 32.65. So 32.65 would be your entry because that's your rejection block, the lowest down close in that swing. And we don't need, as I mentioned in the previous recordings and touched on how rejection block is important, but you don't need the old highs and the old lows to be broken. While that's still within the scope of the optimal trade entry, that is your entry for that. Or you can use this low to this high as it trades back down into bullish order block and fair value gap right in here. Goes a little bit beyond that. It's not important. Remember, the tails and the wicks are always going to be erroneous in terms of the precision element. The bodies is what we're looking at predominantly in the candles. And you can see that the price does in fact start to take off. Now, do you use just this 2 standard deviations? Yes, if you're in the YouTube universe where those individuals outside the mentorship, that's what I taught them, and there's certainly nothing wrong with that. I mean, you can do exceedingly well with it. But if we take our fib and put it over on our price swing here, so we have a price fulcrum. So we have a high down to a low. If it breaks this, it should trade up to 1 standard deviation of 36 and 6. And let's scrunch this up. Boom. There you go. So again, this is just one approach to getting in sync with a move that's going to be trading higher on a longer term basis, not just simply using it as a day trade, just using it as an entry technique for a larger scale short term or swing trade for trading the commodity market, or any market really, but this is a commodity market, crude oil, and it's not a forex pair, but it's the same thing that exists and you can use for forex. So let's go into example number 17, which is British pound for a buy on June 1st, 2020. All right, folks, here is the British pound on June 1st, 2020, and we have our price swing here as outlined on the video. Price is trading back down into optimal trade entry here. Admittedly, we can see clearly that this is an order block in here, but I prefer to use the order block that has a fair value gap. So that would be here. So even though this is still absolutely fine, there's nothing wrong with that, and it's after running some equal lows in here. I'll take the fib off for you to see it. So you have relative equal lows. It runs through it, and then we break higher, clearing the high here. So then we have a break in market structure, comes back down. We can add the fib back on. That is nothing wrong with that. Okay, absolutely nothing wrong with it. But with this profit objective here, it's not the entire daily range that we're able to capture. You know, we're looking at a little bit longer term price move on a higher time frame, but we can utilize this to get in sync with it. I would have elected to use this entry pattern in here over this one, and now I'm going to tell you why. Not only do we have this run and the retracement back down in, I would have watched to see if we get a price run in here, because we're well below this high right here. So I want to see, does it create a fair value gap, which it does right there. Okay, right in here, that's what I want to see. So now if it does that, I can take this price leg here from this high down to the low, and that'll give me my projections. So in this case here, it's 1.25 and 0.1 and 9 pipettes. So basically 25 and 2 pipettes rounded up. Now, in here, we have the fair value gap. See the bodies? I don't care about the tails, the bodies. That's the real institutional order flow. Okay, so the way I teach order flow, it's not that stuff you see about with depth of market ladders and all that point of control. That's all nonsense. Before those things register on their indicators, okay, I already know where the trades are going to form. Okay, I already know. I know days before. I know hours before. I know. So it's not a matter of will this stuff work for me and not for you. Now, it'll absolutely work for you, but you have to know the rules and you have to know what you're looking for. So inside of this price leg here, we do still have optimal trade entry. Now, again, this is what I mean when I say the fib is not the secret. It's not that this Fibonacci is a requirement. Only thing it's showing you is, watch. Right in here, the 50 level, okay, 50 level is where the bodies are. Remember, when we're looking at buying, we have to be at the 50 level or under to be in a discount market. If we're selling short, we have to be at the 50 level or above it within the dealing range. What's the dealing range here? Dealing range is the low to this high. Why am I using this price leg here? Because we had a move away off of another level that was already suggesting bullishness. Remember the optimal trade entry from here to here and then down in? It's inside the window of opportunity for the New York session, but I want to see order flow on my side. So the market runs, doesn't need to break this high because I already have the context back here. I already got the context over here because we broke equal lows and inside of a daily bullish bias. How's the daily bias bullish? Because it's looking to go higher. It's wanting to go above those relative equal highs on the daily chart, as we were talking about. And the market does, in fact, you can see it has done that. Now, for you new folks that just came in, just go back and look at the recordings and you'll see we were looking for it before it happened. But nonetheless, the dealing range low, dealing range high, comes back down in, fair value gap filled, bang. That's where my entry would be. Not down here because I want to see more substance behind the move. Because at this point here, I'm still well underneath this high with the expectation it's going to run through that. And here's my objective for the day, and then bang, I'd be out. And yes, it goes a little bit higher for the day, but I don't care. This is plenty. Okay, it's plenty. It's 100 pips, over 100 pips. So looking at this price move here to here, it's logical and everything makes sense. And now you can see how just some of the things that you learn in the mentorship applied to this really amplifies that YouTube example. So now we're going to look at the example number 18, and it's going to be on the bond market. It's a short on June 2nd, 2020. All right, so here's the bond market. This is the September delivery month for 2020. And the symbol is ZBU2020 on TradingView, just so you guys know. All right, so I'm going to give you an example how we use nested optimal trade entries within market structure so that we can not only take a trade, but also take a same trade someone else would be doing, but with lower risk. How's that? All right, so we have this example here on the 18th example in the optimal trade entry pattern recognition series on my YouTube channel. The June 2nd example here. Shorting bond market. We had this optimal trade entry right in here. This was the dealing range right there. All right. Now, at this New York session window, isn't this high here inside that? Yes. What's the parent price swing it's inside of? This high to this low. There's your sell, but wait to see if it breaks down. It does. Starts to rally back up, trades back up into a bearish order block. Last up close candle right here. And then we want to see it break down. Now, this is the example calling for, in my mind, that's a perfect trade. There's nothing wrong with getting out there. Okay, there's certainly nothing wrong with it. But using the parent price swing here to here and a retracement back up in. See, look at the optimal trade entry area here. Just extend that out in time. I'll try to do my best to keep it right on that low. Now, you can see inside of this New York session, it trades up into almost a 79% retracement level. Falls off a little bit, comes back up, 62% retracement level, still within the New York session. And then we want to see it expand down and take out these relative equal lows. So relative equal lows in here, on that low comes in at 176 and 30 seconds. Because bonds trade in 30 seconds. Every one tick is worth $31.25. If we go back and anchor it to here, high to low, 1/2 a standard deviation takes us down to this low here, well beyond that one. And just a beautiful example of how we can use nested optimal trade entries. Now, the benefit is this. If you're selling short from this, this, and this, and as your entry, using that pattern, your stop has to be above this high. Using this, from this to here and back up, your stop only has to be above here. Remember, I showed you it was like a 2-tick stop. Ridiculous. Versus what would otherwise be up here. Okay, so it helps you refine the risk. And even though you have a little bit of heat here, it's nothing. It's nothing compared to taking an entry here and putting the risk up here. There's nothing wrong with that trade. Absolutely nothing wrong with that. But I like to look at things like this where I can really reduce it and get the maximum amount of leverage, but still not overcome the risk parameters that I have set in place. So in other words, if you were trading at 1% risk, 1% risk on something from this leg here to here and entering here, your stop has to be above there. Versus something like this where you're using the framework of that entry relative to this high, because this here is an optimal trade entry. That is an optimal trade entry. This is a smaller optimal trade entry because it's a fractal with the same pattern that's existing here is occurring right in here. So it allows us to reduce our risk and not break our risk management protocols and allow us to have maximum leverage without over leveraging or over risking, if you will, any amount of money on any one particular trade. So it helps us refine the risk and move closer to making maximum profit and still keeping risk relatively low. All right, so our next example is going to be example 19 in the series, and this is going to be in $yen. It was a buy on June 3rd, 2020. All right, so here is example number 19. This is the $yen. This is a long example using optimal trade entry and in the New York session for June 3rd, 2020. So you can see right away we have the New York session label crooked, and I have to fix that. Sorry, folks, but my OCD just cannot let that be. I have to fix that. And you can see it drives me crazy. All right, so we have a consolidation in here, which means there's buy-side liquidity resting above these highs, which we're going to be looking for a low resistance liquidity run to raid that. And you can see the optimal trade entry here. Our dealing range low is here, dealing range high here. And look at the bodies of the candles in here. It retraces back down into this fair value gap, which I'll take off right now. As you can see it, fair value gap, bodies of the candle, tail of the candle. Again, that's erroneous price action. It means that it's what your broker is going to be allowed to do. It's legal. You sign an agreement when you join with them and open up an account, and that's the inherent risks that you assume. So again, the fair value gap in here, body comes down into it, and optimal trade entry is what we're looking for. So why am I anchoring there? Because we closed the fair value gap in and we started the price run. We broke a high, so that's our dealing range. Okay, and it's below this high, which we're anticipating a run above. Optimal trade entry, beautiful, down close candle, and bullish order block. So you can see a run up, immediate rebalance in here. Price runs above, and it gets to 1.5 standard deviation right there, and it ultimately gets to 2 over here. And that by itself is absolutely nothing wrong with that. But let's put a little twist on it, mentorship style. So we have the old high back here, and its high is 108 and 85 in 2 pips. 30 pips above that takes us up here. So project that out in time. Well, that's pretty close, isn't it? Well, this level here, we're going to add our swing trading model targeting. You learn this in the core content, and I've been showing you in these examples already. Why am I using this price leg and not this price leg, Michael? Because this price leg has already had multiple attempts and came really close to filling it here. We had this deep retracement coming back down to a fair value gap. Then we started to move higher again. So now this becomes the move, or the leg at which we want to measure from. Takes us up to 109 and 15, and bang, hits it right there. Beautiful, isn't it? Only went like a pip over it. Not even a pip, probably. Let's see what the high is. Nope, not even a full pip. It's 16 and a half, and this was 15 and 9. So again, beautiful, beautiful reaction there. Look at that. It's like magic. All right, so finally, let's get to example number 20. This is the Eurodollar. This is a long entry in the New York session on June 4th, 2020. All right, folks, this is the Eurodollar on June 4th, 2020, and your New York session opportunity for taking a trade. You can see the price starts to create a run here, and we have a busy buy side imbalance, sell side inefficiency, and I'm going to show you what that CE is. It's consequent encroachment. Only thing I'm doing is taking the body here up to this candle's low here. No, work with me here. Here we are. So it's this candle's low, this candle's high, midpoint right here. That's consequent encroachment. Look at the bodies of the candles. Magic. I love this. Anyway, this is where you would take your long, consequent encroachment. You don't need the complete closure of the gap. You want to keep it there. And that will act as what? It'll act as a breakaway gap. Then, using the optimal trade entry right in here, and we'll extend this out in time so you can see how lovely that is. Right there. So you have consequent encroachment, and inside of optimal trade entry, 62, 70 and a half, 79 never gets to it. So I'd like to use the 62 in the YouTube video series because it's easy for the public outside of mentorship to get in, I guess, in sync with the move and not have to require having all the precision down here that you'll end up learning in the mentorship here. So you have consequent encroachment, beautiful reaction there, hits the 70.5 level here, but look at the bodies there. Perfect on consequent encroachment. Beautiful, beautiful, beautiful. For your notes, for you new folks that maybe haven't got that far into the lessons, maybe you've heard me say it a few times, consequent encroachment is the middle of a gap. Okay, a gap can be a wick, a tail, an area where it's just one single candle. Each of these have unique characteristics, and I've taught several of them in this video so far with the gaps, breakaway gaps, measuring gaps and such, and incorporating market structure within it and doing the swing measurements so we can grade our price swings to see where future price moves will likely to occur. Right away, we have a 1.5 standard deviation at 138.82, and never really quite got there, did it? So that would look like a little bit of a disappointment. But now watch what we do here. We're going to refine the fib, calibrate it to the bodies. Nothing changes for optimal trade entry. It's still optimal trade entry and consequent encroachment. You see that? Nothing's changed. Here, let me draw it out in time so you can see nothing has changed. It did not distort the optimal trade entry. The only thing it does is calibrates our entries and targets. Target 137.43. Beautiful. Now add also, you have 136.25 as an old high. 20 pips above that, 136.82 in 5 pipettes. Handsome, isn't it? So it's relative equal highs. The higher of the two, and looking for 10, 20, and 30 pips grade. Now, you may have a target that would have been a little bit higher than this that didn't get its final objective, but you scale out at whatever your progressive targets are on your fib. You want to be scaling out, and you may not have got out at the ultimate higher one. Okay, in other words, something like up here, you didn't get to that one. It doesn't matter because you would have gotten out at logical levels. And when you see these relative equal highs, if it trades above that, you certainly want to be taking something out there. And you all knew that anyway. So that's going to be it for this. We've completed the 20 examples in the Optimal Trade Entry Pattern Recognition series on my YouTube channel with a little bit of flair. Now, obviously, I don't have everything in the mentorship here. It's just to simulate the difference and you observing what is taught and shown in that series and on my YouTube channel versus the things that you learn here in the mentorship. Now, we go way beyond this, and there's much more precision elements involved, but that's going to have to suffice for right now, because the only thing I'm going to do is give a little bit more amplification of what I shared publicly. Now, I want to go over to the forum and show you how to search for things, because one of the things that came up a lot recently because of the new members coming in, this will also help you use the forum more efficiently. All right, so we are on the forum, and when you're in the ICT Mentorship forum, if you want to look for something, okay, if I say use the forum and search for this or that, one of the things that you hear me talk about is the trade journal. And if you go into the forum and you look in the search tab, click that, and then where it says keywords, you want to type in journal. You can already see that I've done this already. I made videos of it, sent it to individual members. And I said, I'm just going to make a video in the mentorship and show everybody. So here's where you do, like, say you want to see a journal. Okay, click on that, hit return or enter on your keyboard. And now it'll give you, now you're not, if you're new members, okay, and you're not a charter member, do not freak out and say, I don't have these threads, because you're not going to, okay? You're not going to see all these threads. I am an administrator. I can see everything, okay? So again, there's going to be threads here. Threads are like the labels over here. You're going to see a lot of these things, and it's going to look like, wait, I don't have access to that, Michael. Don't email me. When you look for something in the forum, okay, and you can do this without being a charter member, because you want to be able to find where I'm talking about or teaching a specific thing. The topic I searched on here is journal, and you're going to see whatever your membership level allows you to see. You're not certainly going to see this because this is in charter level, and these aren't my threads. These are threads created by other members. So you want to scroll down to where you see commentary. Okay, so if you scroll down to there, you see that? January 2019 commentary. When you find a thread that has commentary in it, that is going to most likely be what you're looking for. So if you click on that, it'll open up everything in that particular month, and it's basically the 8 or so videos that go in to each month's weekly commentary. So it's 2 per week. And you can see here on Friday, January 4th, 2019, don't get thrown off by these 2 links, because at one point these were 2 separate links, and because I haven't had time to go back in and change it, the only thing we did was just clean up the links, and now these links are the same. Okay, so if you look at this and you become a charter member and you say, oh, let me go back to this later, everyone was seeing the same commentary. Nobody was seeing anything different. It was just me tracking them, because they would go to a subgroup that would, their watermark would be applied there versus the members that would be in core content. We had various ways of tracking individuals, and I was throwing people out in the past, but I haven't cleaned this up. Usually it's just one link like it is now, but back then in 2019 we had 2 different links. Anyway, the topical study inside of this presentation, setting up a study journal. Okay, so if you watch this video here, it'll show you how to use Excel and how to organize and save screen captures and put keywords in there, so that way you can go into your own Excel file and find things that were relating to European opening range or Asian range standard deviations. Okay, so anytime you use something in your logging of your journal entry, you want to be putting in, as I'll show you in here, keywords that would help you find that example that would be relative to a topical study. So if you want to go back and look at all of the New York session setups that you did, okay, when you do your journal entries, if you put in New York session as part of your keywords, when you do that on Excel, it'll pull up your entries based on that, just in the same way that I just did a search on this forum. It will act just like that. Now, I know there's a lot of folks in the forum that have been commenting how they use Edgewonk as their journaling. I don't have any affiliation with them. I honestly don't want to come across like I'm selling you products, but there's a lot of positive feedback from that, and you're welcome to investigate it and take a look at it yourself. And if that's something that's more user friendly than using an Excel, I'm old school. Like I'm Lotus 1 2 3 kind of guy. Okay, that all that stuff makes sense to me, and all the newer things, people may gravitate towards that. But spreadsheets are something I've always worked with, and if I were not into the high touch versus the high tech, I draw out my journal entries. I don't screen capture and put them in anything. I'd look at what the chart shows, and I draw a line depiction, and I just sketch where the things are, and that's how I internalize it anyway. The mode of my journaling isn't the same as what I teach you to do, because it's more efficient to do it like with an Excel, or maybe even using an Edgewonk type application or resource. But I just simply don't want to try to force those types of things on you, because I'm going to give you the lowest cost or no cost approach to doing it, and that's using just simply an Excel spreadsheet, and that's explained here. Another way of finding things topically is like you heard me talk about in this video, and if you're new, just came in a new group, the institutional order flow entry drill, which was the abbreviation of IOFED. Okay, so IOFED. That is an institutional order flow entry drill. If you click on that, hit return or enter on your keyboard, again, you're going to look for the commentary. Okay, everything else is just going to be if you're a charter member. If you're not a charter member, you're probably just going to see this. You click on that, and I don't know if it will show those other tabs, and you may not be able to get to it. I'm not sure if it shows it because of your membership level in the forum, but nonetheless, you always look for the commentary thread, and you'll see it discussed there. All right, so what do we got here? Scroll up, and what you're doing is you're looking at where it's like topical study, lesson focus. You're looking for anything where it says institutional order flow entry drill, and there it is. Okay, cable review and teaching on institutional order flow entry drills. So it's on March 11th, 2019. So in that, I actually talk about what I showed you in contrast to when a fair value gap fills and when we don't want it to fill, and how that works within the hierarchy of creating a price swing. All these things fit together, folks. And that's why when you get pieces of it along the way, you get more amplification. Just like today, I taught something relative to the measuring gap, the breakaway gap, and grading a price swing using institutional order flow. That has not been taught anywhere else. Charter members have not received that lesson. They received it just like you did in this commentary. So that's why I tell everyone, when you send me, and especially all the new folks that just came in, I don't know what this order block is. How do I know what order block? I understand your excitement. You feel like you have to know everything right now or you're going to get lost. You need to take your time, because there's so many lessons that build on previous lessons that are required. I'm not going to answer your email with, oh, here's what it is, and you're going, oh, thank you, I now know what I'm talking about. No, it doesn't work that way. Now, I can take you to resources in the forum that'll help you amplify that, or you can simply do what I'm doing here. If you hear something mentioned in the commentaries, use this feature, and it'll allow you to go into the commentaries and take you right to that specific thing. Now, outside of that, you may just simply have to wait until you get to the new lessons that are part of the natural progression through the core content of the mentorship. So hopefully you guys got something out of this one today. I'm really excited about tomorrow's weekend edition commentary. So I'm going to really amplify daily bias for you, so that way you guys can see what you're supposed to be doing, how you're supposed to be doing it each day, how to practice, how to forecast a likely daily bias, and then use that with what we just saw this past week. Until then, enjoy the rest of your weekend, and I'll talk to you tomorrow.